In just a few days, the largest wealth transfer in American history begins. It's not a crash. It's not a bailout. It's a flood. $4.7 trillion is about to pour into the U.S. economy, and 90% of investors have absolutely no idea it's coming. Wall Street knows. Institutions know. The money is already positioning. Trump's plan isn't just policy. It's a market catalyst, one that will create new millionaires and absolutely destroy portfolios that aren't positioned correctly. I'm going to walk you through the exact timeline, the 5 waves of capital flow, and the 6 sectors that will absorb this money first. But here's the catch. The window closes fast. Stay until the end because I'll also give you the exact dates and the positioning strategy we found. I've spent years in banking and law, and for the last 15 years, we've been analyzing policy cycles and how money actually moves through markets. I warned about the 2022 inflation spike when everyone was calling it transitory. This isn't political. I don't care if you love Trump or hate him. What I care about is what happens when $4.7 trillion hits the market, because history shows us exactly what comes next. And if you're not positioned ahead of it, you don't participate. You just watch from the sidelines while others multiply their wealth. So let's break this down step by step. Here's what most people miss. Trump's 2025 tax cuts, the so-called Big Beautiful Bill and Jobs Act 2.0, were never just about lower taxes. They were about timing. The bill passed in March of 2025, but the economic impact hits in 3 major waves. Wave 1 runs from April to June of 2026, tax refund season, except this year it's being pulled forward. Refunds are starting as early as late February. Wave 2 runs from July through September, corporate repatriation. I'll explain why that matters in a second. And Wave 3 hits in the 4th quarter, bonus depreciation and capital expenditure. Now here's why this matters. According to Congressional Budget Office and Treasury estimates, individuals will receive roughly $1.2 trillion in tax refunds, about $8,500 per household. Corporations will receive approximately $2.1 trillion in repatriated overseas cash. And another $1.4 trillion will flow into accelerated depreciation and business investment. That's a total of $4.7 trillion entering the economy in just 9 months. For context, that's 3 times the size of the 2008 bank bailout. The COVID stimulus package was about half this size. This is nearly 20% of the entire U.S. economy hitting the market in less than a year. We've seen this before, just not at this scale. Look at the 2017 tax cuts. What happened? The S&P 500 rallied 28% over the following 18 months, and that was driven by just $1.5 trillion. The Bush tax cuts? Small caps surged 47%, REITs jumped 38%. Go back to the Reagan tax cuts in the early 1980s, and the Dow rose 135% over the next 5 years. But here's the critical difference. In 2026, we already have historically low unemployment. The Fed is cutting rates, and consumer demand is still pent up. This isn't a recovery cycle. This is rocket fuel poured onto an already hot economy. And this is exactly where most investors mess it up. They react instead of anticipate. By the time CNBC starts talking about a tax refund rally, the easy money is already gone. The institutions are already positioned. The smart money is moving now, before refund checks ever hit bank accounts. And this is where I want to pause for just a second, because knowing that something is coming is one thing. Knowing what to do with it is everything. This is why I run my private group, where you can get access to exclusive weekly videos showing the exact stocks I'm buying. It's about learning how to see opportunity before it's obvious, and thinking the way top 1% investors think. If you want access to those stock alerts and the exact framework I use to navigate moments like this, it's linked in the pinned comment below. All right, back to the money. This $4.7 trillion doesn't hit all at once. It flows through 5 distinct waves, and each wave creates different opportunities. Miss one, and you leave money on the table. Wave 1 is where we are right now. The bill has passed, but the money hasn't moved yet. This is when institutional investors front-run refund season. You start to see defensive sectors weaken, utilities, consumer staples, while growth stocks and small caps quietly begin to outperform. Volatility drops. The VIX fades. Uncertainty clears. So where does capital start flowing? Historically, this phase favors small caps, consumer discretionary, and home builders. In late 2016, right before the prior tax cuts, small caps rallied 15% in 3 months. Large caps gained just 6%. The Russell 2000 outperformed the S&P by 9 percentage points in a single quarter. That's the setup we're seeing again. Wave 2 is where things get explosive. This is the refund flood. And if you were paying attention earlier, you know it's coming earlier than ever. Late February, the earliest in history. That's $1.2 trillion hitting consumer bank accounts. And this is where behavior matters. People don't save windfalls, they spend them. And when that spending accelerates, the next phase of this cycle kicks in. Now, the average household is about to receive a pretty serious check, roughly $8,400. So the obvious question is, where does that money actually go? We don't have to guess. We have historical consumer spending data based on IRS and Treasury behavior. And here's how it breaks down. About 35% goes straight to debt repayment, credit cards, auto loans, personal loans. As much as people love to complain, Americans are surprisingly responsible when cash hits their accounts. Another 25% goes to discretionary spending. Think vacations, travel, home improvement, electronics, appliances, all the stuff people delayed when money was tight. Then roughly 20% goes into savings and investments, brokerage accounts, retirement accounts, maybe a little crypto, maybe a little gold. And the final 20% goes to necessities, rent, utilities, groceries, insurance. So what happens next? Retail stocks love this. Think Amazon, Walmart, Target, Home Depot, Best Buy. Travel and leisure love it too. Airlines, hotels, cruise lines, booking platforms. When people suddenly feel richer, they don't sit at home staring at their bank balance. They move. Brokerage firms benefit as well. Robinhood, Fidelity, Schwab. More cash hits accounts, more trading activity follows. And even credit card companies rally. Despite all the noise about regulation and pressure from Trump, Visa, MasterCard, American Express, when spending increases, transaction volume rises. Once the dust settles, something else happens. People bought more stuff, companies posted higher revenue, profits increased, earnings multiples expanded, and more money flowed back into the market. It's a feedback loop. Boom. If you want a historical example, look at the 2008 Bush stimulus checks. Retail sales jumped 12% in the single month those checks were distributed. This time around, the stimulus is 7 times larger. 7 times. Big, beautiful, enormous. Yes, there's a long-term debt problem attached to all of this, but we're not here to be responsible adults right now. We're here to understand the cycle and take advantage of it. Now let's move to Wave 3, corporate repatriation. And no, these are not dead bodies coming home. The tax bill includes a one-time repatriation holiday, allowing U.S. corporations to bring overseas cash back into the United States at a reduced tax rate. We're talking about $2.1 trillion currently parked in foreign accounts. Why is it overseas in the first place? Taxes. Companies like Apple, Microsoft, Google, Netflix, they've been holding cash in places like Ireland, the Netherlands, and other extremely tax-friendly jurisdictions. No disrespect to the Irish, wonderful people. But corporations didn't move money there for the Guinness. So who benefits most from repatriation? First, megacap tech, Apple, Microsoft, Google, Meta. These companies alone hold over $500 billion overseas. Second, pharmaceutical giants, Pfizer, Johnson & Johnson, Merck. Third, industrial conglomerates, GE, Honeywell, United Technologies. Now, here's the part investors care about. What do companies actually do with repatriated cash? History gives us a very clear answer. About 40% goes into share buybacks. That reduces the number of shares outstanding, which mathematically pushes remaining share prices higher. Another 30% goes into dividends. Everyone loves dividends, especially institutions, especially retirees, especially funds that are mandated to hold income-producing assets. About 20% goes into mergers and acquisitions, which is often questionable for long-term value, but phenomenal for investment banks arranging the deals. Somebody has to pay for those Hamptons houses, right? And the final 10% goes into actual business investment. So what does this tell us? Megacap tech benefits. Dividend-focused stocks outperform. Dividend aristocrats like Johnson & Johnson, Coca-Cola, Procter & Gamble tend to shine. M&A activity increases, which benefits investment banks and advisory firms. The last time we had a repatriation holiday was 2004. Back then, companies brought home $312 billion. The S&P 500 rose 15% that year. Tech stocks rose 22%. This time, the repatriation is, once again, 7 times larger. So the takeaway isn't complicated. Megacap tech, dividend payers, capital markets beneficiaries. Now let's move to wave 4. And no, this one isn't an attack. It's an injection. Bonus depreciation. The tax bill allows companies to write off 100% of capital investments immediately instead of depreciating them over multiple years. That creates a massive incentive to spend now. So who benefits? Heavy equipment manufacturers, Caterpillar, Deere, 3M. Construction and engineering firms, Fluor, Jacobs Engineering. Infrastructure and systems companies, Cisco, Oracle, Salesforce. Energy and utilities, grid modernization, solar, wind, transmission upgrades. This wave alone represents roughly $1.4 trillion in capital expenditure. A huge portion of that will go into automation, artificial intelligence, energy infrastructure, and reshoring supply chains back to the US. If you're looking at this thematically, industrials and materials tend to benefit. Historically, ETFs like XLI Industrials have done well in these cycles. Materials like steel, copper, and aluminum outperform when infrastructure spending ramps up. Want another historical reference? In 2017, business investment rose 6%. Industrial stocks climbed 34% that year. Not bad. So what do you focus on here? Companies with strong order backlogs, commodities, especially copper. And with labor markets still tight, there's a side effect nobody can ignore: inflation. And inflation is good for what? Gold, silver. Exactly. But here's the uncomfortable truth. Flooding $4.7 trillion into the economy doesn't come without consequences. It will create inflationary pressure. We've seen this movie before. When the Fed printed trillions during the COVID era, liquidity drove asset prices. And understanding when and where that liquidity flows is the difference between riding the wave and getting wiped out by it. Anyway, the Fed is going to respond. And this is where things get tricky. In a normal environment with a truly independent Federal Reserve run by economists who believe they're always right, inflation would trigger rate hikes. That's how it's supposed to work. But 2026 is not a normal environment. We are getting rate cuts. Why? Because Trump wants them, and he's going to appoint people who will give them to him. Now, after the midterms, if inflation accelerates and we start pushing back toward 3%, then yes, rate hikes come back on the table. That's the risk window. And Trump is doing everything he can to make sure that doesn't happen. You've probably noticed it already. Lowering oil prices, capping credit card interest rates at 10%. No more, pushing to lower housing costs. The goal is simple: make everyday inflation feel invisible. Gas feels cheaper. Food stabilizes. Credit card bills stop rising. So people keep swiping the plastic and think everything is fine. But here's the part most people miss. The real measure of inflation isn't groceries or gas. It's asset prices. If the stock market rises 25%, that is 25% inflation. Why? Because your salary didn't go up 25%. But people who own stocks, real estate, gold, silver, and other hard assets just got 25% wealthier. Flip that around. If you don't own assets, your money just lost purchasing power. That's the uncomfortable truth, which leads to the only logical conclusion. Put as many dollars as possible into assets. That's how this system works. Now, here's the timeline risk. This liquidity wave pushes markets higher in 2026. But if inflation rears its head again, like it did in 2021 and 2022, rate hikes come back in 2027. And when that happens, leadership changes. Look at 2021 and 2022. Energy stocks were up 65%. Tech stocks were down 35%. People forget that part. So the real strategy isn't just riding the rally. It's knowing when to take profits from high-valuation growth stocks and rotate into sectors that benefit from tightening conditions. That's risk management. Now let's get practical. Where does the money go? For Wave 2, the refund flood, the obvious winners are consumer-facing giants: Amazon, Home Depot. If you want broad exposure instead of individual stocks, there are ETFs that cover this space. Technology is still a major beneficiary. Apple has massive buyback potential once repatriated cash comes home. Microsoft benefits from enterprise spending and cloud growth. QQQ captures that entire basket. I remain very bullish on Nvidia, very bullish on Alphabet. Advertising revenue recovers in strong consumer cycles. AI monetization accelerates. These companies print cash. So yes, there's serious upside potential this year. Financials also benefit. M&A activity picks up. Investment banking ramps. Capital markets get busy again. JP Morgan, ruler of the world, lord and master, benefits enormously from this environment. Goldman Sachs thrives when deal flow returns. Despite the political pressure, companies like Visa continue to grind higher on volume alone. Brokerage platforms benefit too, Schwab, Robinhood. Retail trading surges when liquidity rises. If you want broad exposure to financials, XLF covers the sector. I'm bullish, though slightly less aggressively than tech and consumer, but it's still a meaningful part of the cycle. Now, as we move later into the year, energy comes back into focus. If the Venezuela situation becomes clearer, Exxon, Chevron, ConocoPhillips benefit. That's more of a late 2026 positioning decision. Energy majors don't move overnight, but when inflation expectations return, they matter. NextEra Energy and other infrastructure-focused energy companies also benefit, especially as grid modernization accelerates. Again, timing matters. We want clarity before going all in. And then we get to Sector 6, real estate. Why does this work? Because tax refunds function as down payments. Combine that with falling interest rates, and housing demand explodes. REITs benefit. Industrial and warehouse REITs are already performing well. Residential REITs become more attractive as rates come down. Equity residential, EQR, is one name people look at. Simon Property Group, SPG, is another. And for broad exposure, VNQ covers the real estate sector. This is not financial advice and is for educational and entertainment purposes only. But understand this isn't random. This is a liquidity cycle. For $0.7 trillion doesn't quietly enter the economy. It reshapes markets. And the difference between people who benefit and people who don't comes down to one thing: preparation. There's one more beneficiary people keep overlooking. As interest rates come down, SoFi. Student loans are going to get refinanced, and SoFi is the #1 student loan refinancing platform in the country. Lower rates mean refinancing volume explodes. That's a direct tailwind. So what does the timeline actually look like? If you want to front-run this cycle, that's where the highest risk sits, but also the highest potential reward early on. Small caps tend to benefit. Think IWM VB, that type of exposure. You can also lean more bullish on consumer discretionary. XLY is a common ETF people look at. Reducing bond exposure at this stage is almost a no-brainer, at least conceptually. Retail is another area to watch. There's XRT for retail exposure. Travel and leisure as well: airlines, hotels, cruise lines. When liquidity rises, people move. As we move into the middle of the year, consumer discretionary still holds up. Inflation data will be watched closely, but at some point, it becomes noise. Liquidity tends to matter more than headlines. Through the summer, corporate repatriation really starts to shine. That's where megacap tech and dividend payers step into the spotlight. QQQ is the simple, broad way to capture that. Dividend-focused ETFs like VYM or SCHD tend to benefit as well. Then we move into the third quarter. That's when the capital expenditure boom kicks in. All that free money companies can write off immediately starts flowing into equipment, infrastructure, automation, AI, energy, and reshoring supply chains. Industrials come into focus. XLI, materials and commodities tend to front-run: steel, aluminum, copper. I remain very bullish on gold and silver. It'll be choppy, especially silver, but structurally bullish toward the end of the year. That's when we start watching inflation closely again. What are inflation hedges? Gold, tips, Bitcoin, energy stocks. And that's also when it may make sense to start taking profits on the highest valuation growth and tech names. That's how I see the year playing out. And yes, a lot of this is ultimately driven by one person at the center of the chessboard. You know who I mean. Now, could something go wrong? Of course. The Fed chair could decide to do his own thing. We've seen that before, appointed by Trump, card-carrying Republican, and still printed $4 trillion like it was a hobby. Hard to stop once you start, right? Consumers could also decide not to spend. They could say, "We're scared about the future. AI is coming for our jobs. Let's save." That's possible. But even if they save, the money still flows, just differently. Retail might cool off a bit, but savings flow into brokerage accounts, Robinhood, Schwab, Fidelity. That still supports markets. And what do consumers buy when they invest? They buy names they recognize: Microsoft, Amazon, Apple, Tesla, SoFi, Robinhood. That's just human nature. Some people will say, this is already priced in. I don't buy it. When I talk to people outside of very informed Wall Street circles, they're shocked this is even happening. So if you're watching this on Newsix Brief, you're already ahead of the curve. And if you think more people should understand what's coming, share the video. That helps a lot. And before we wrap up, I want to leave you with this. Gold and silver are both sitting at or near all-time highs, and your gut might be telling you that you've missed the boat. But here's the problem with that thinking. Central banks are buying gold at levels we haven't seen since 1967. Now, let me expand on what this really means for the average investor and why understanding liquidity cycles is the single most important skill you can develop in modern markets. Because what we're about to witness isn't just a policy-driven rally. It's a fundamental reshaping of wealth distribution that will echo for decades. The concept of liquidity-driven markets is something most retail investors fundamentally misunderstand. They think markets move based on earnings, fundamentals, or even news. And while those things matter at the margins, the overwhelming driver of asset prices over the medium term is one thing: how much money is chasing those assets? When $4.7 trillion enters the system in less than a year, it doesn't matter if a company's earnings grew 5% or 10%. What matters is that there's suddenly vastly more capital competing for the same shares. This is why you see situations where stocks rise even when economic data looks terrible, or why markets can fall even when companies are posting record profits. The market isn't pricing in fundamentals, it's pricing in liquidity. And right now, we're about to experience the largest liquidity injection in American history outside of wartime. What makes this particularly significant is the timing. We're not in a recession. We're not in a financial crisis. The labor market, while showing some signs of cooling, is still relatively strong. Consumer balance sheets, while stretched, haven't collapsed. Corporate profits are solid. In other words, we're injecting massive stimulus into an economy that doesn't desperately need rescue. We're accelerating an economy that's already moving. This creates a very different dynamic than the 2008 bailouts or even the COVID stimulus. Those were emergency measures designed to prevent collapse. This is rocket fuel designed to accelerate growth, reward investors, and create a wealth effect that makes people feel richer, spend more, and vote accordingly. It's economic policy with a very clear political objective. The consequences of this are both exciting and terrifying, depending on where you sit. If you own assets, stocks, real estate, commodities, you're about to experience significant wealth appreciation. Your portfolio will grow not because you picked brilliant stocks, but because the ocean is rising and all boats are lifting. That's the power of liquidity. But if you don't own assets, if you're living paycheck to paycheck, if your wealth is stored in cash or low-yield savings accounts, you're about to experience the opposite. Your purchasing power will erode. The gap between asset owners and non-asset owners will widen dramatically. And this isn't speculation. This is mathematical certainty based on how money flows through the economy. This brings us to a critical point about inflation that almost nobody talks about. When economists and the Federal Reserve discuss inflation, they're primarily focused on consumer price inflation, the cost of groceries, gas, rent, services. And they use tools like interest rates to try to control it. But there's another form of inflation that's far more significant for wealth inequality: asset price inflation. When the stock market rises 25% in a year, that's 25% inflation for anyone who owns stocks. When real estate prices jump 20%, that's 20% inflation for homeowners. When gold climbs 30%, that's 30% inflation for gold holders. But none of that shows up in the CPI. None of that gets counted as inflation in the traditional sense. And yet, it's the most powerful form of inflation because it directly determines who gets richer and who falls behind. This is why putting money into assets isn't just a good strategy. It's the only strategy that makes sense in a fiat currency system where money supply constantly expands. Every dollar sitting in cash is a dollar that's guaranteed to lose purchasing power over time. Every dollar invested in productive assets is a dollar that has the potential to compound and keep pace with, or exceed, monetary expansion. The historical precedents for what we're about to experience are actually quite clear. Every major tax cut and repatriation cycle in modern American history has led to a significant market rally. Reagan's tax cuts in the 1980s sparked a multi-year bull market. Bush's tax cuts in the early 2000s created a strong rally despite the dot-com aftermath. Trump's 2017 tax cuts drove the market higher for 18 months straight. And in each case, the investors who positioned ahead of the cycle captured the majority of the gains. But there's always a catch. These liquidity-driven rallies don't last forever. Eventually, the money gets distributed, spending patterns normalize, and either inflation forces the Fed to tighten, or market valuations become so stretched that even continued liquidity can't justify further gains. That's when the cycle turns. That's when you need to be thinking about profit-taking, sector rotation, and risk management. The skill isn't just riding the wave up. It's knowing when to start positioning for the next phase. And that's where most investors fail. They get caught up in the euphoria. They extrapolate recent gains into the indefinite future. They ignore valuation concerns because this time is different. And they end up holding positions through the entire downturn, giving back all their gains. The winners in these cycles are the ones who understand the sequence. Accumulate before liquidity hits. Ride the wave aggressively while it lasts. Start taking profits as euphoria builds. Rotate into defensive positions before the turn, and position for the next cycle while everyone else is panicking. It's not complicated in theory, but it's incredibly difficult in practice because it requires going against the crowd at precisely the moments when the crowd seems most right. Right now, we're in the accumulation phase. The policy is set. The money is coming. The mechanisms are in place. But the psychological shift hasn't happened yet. Most investors are still cautious, still worried about recession, still focused on risks rather than opportunities. That's exactly when you want to be positioning. By the time everyone is talking about the rally, by the time your barber is giving you stock tips, by the time CNBC is breathlessly covering the surge, that's when you should be thinking about exits, not entries. This is the game. This is how wealth is built in modern markets. It's not about being smarter than everyone else. It's not about having insider information. It's about understanding how money flows, recognizing the patterns, positioning ahead of the crowd, and having the discipline to take profits when others are still buying. That's the difference between people who build generational wealth and people who watch from the sidelines wondering why the gap keeps widening. The $4.7 trillion is coming. The only question is whether you'll be positioned to capture it or watch it flow past you. The window is open now, but it won't stay open forever. This is your moment. Make it count. I wish you a strong, profitable 2026 on Newsix Brief. All the best.